This one executive order could trigger the next stock market crash, and it's already in effect. The markets are nervous, and here's why. Donald Trump just reignited the trade war, not with a campaign promise, but with a signed executive order. On April 2, 2025, Trump brought back his signature move, reciprocal tariffs. And this time, the stakes are even higher. With inflation still sticky, interest rates high, and corporate earnings fading. The big question is, are we heading into a deeper market downturn? Let's break it down and look at what this could mean for your investments. On April 2, 2025, former President Donald Trump signed Executive Order 14,256. It reinstates reciprocal tariffs, starting with a baseline 10% on all imports. Some countries, like China, face tariffs as high as 34%. The European Union? Trump says it's about fairness. If they tax our goods, we'll tax theirs. But global leaders aren't staying silent. China and the EU have already warned of retaliation. And historically, this kind of tit-for-tat policy tends to end in trade wars and market volatility. Goldman Sachs and Morgan Stanley have both issued new warnings. Goldman believes these tariffs could cut 0.5% off US GDP growth this year. Morgan Stanley says investors are now demanding higher risk premiums, meaning more downside pressure on stock valuations. Core PCE inflation, the Fed's preferred gauge, is still sitting above 3.3%. With tariffs now increasing the price of imported goods, inflation could heat up again. That puts the Federal Reserve in a corner, forced to keep interest rates high while the economy cools. Quarterly earnings reports show weakness across key sectors. More than 40% of S&P 500 companies missed revenue targets in Q1. Margins are being squeezed, from rising wages, input costs, and now import tariffs. The market sentiment is shifting and the latest IE sentiment survey shows a surge in bearish outlooks, the highest since 2022. Put option volumes are spiking, and hedge funds are sitting on larger than average cash piles and smart money is getting defensive. Coming up, I'll reveal 3 sectors that could benefit if tariffs hold. Stay with me. The Federal Reserve can't cut rates without risking an inflation rebound. But keeping rates high might push the economy into a mild recession. Now, with added trade stress, the Fed is officially stuck between a rock and a hard place. This is what some economists are calling a stagflation-light environment: slow growth, sticky inflation, and rising political risk. High-growth stocks like Tesla, Shopify, and AMD are already under pressure. Tech and small caps rely on global supply chains and cheap capital, and both are being squeezed. Expect further downside in speculative names if this trade uncertainty continues. Is it time to panic? Not necessarily, but it's definitely time to pay attention. Volatility is rising. Risks are stacking up. But markets don't fall forever. If you have a long-term mindset, this might be a setup for opportunity, not disaster. Here's the move: stay calm. Get selective. Focus on quality. Look for companies with strong balance sheets, pricing power, and consistent cash flow. Avoid meme stocks or overly speculative bets. And consider hedging with defensive sectors, like healthcare, utilities, and dividend-focused ETFs. Trump's tariffs are no longer just political noise, they're active policy. Combined with sticky inflation, Fed uncertainty, and weakening earnings, the short-term outlook for the market is rocky. But with a smart plan, volatility becomes your advantage. If this video helped clarify what's happening, support the channel by liking the video, subscribing, and hitting that bell icon.